All right, it is 9 a.m. I am going to start talking and make sure everything's working and whatnot, and then we will proceed. So welcome everybody. This is session kind of 1.5, session 2 of our 4-session event, the second and the last free one. We are a trading research group. I will be presenting today. I'm Jeff Mayhem. My co-host in the background is Lee, who is in the United Kingdom in London, or London area, actually. Let's just call it England. And he's going to be helping manage the chat and helping with questions and whatnot along the way. So without further ado here, let's clear up the usual legal stuff. Trading is difficult. Do this at your own risk. Everything we talk about here is educational. You know, it's interesting because when I used to watch these risk disclosure things go by back when I first started going to webinars maybe 20, 30 years ago, you know, I'd breeze by this and think, oh, it's just legal mumbo jumbo. But you know what? This is a really hard business and most people fail. So it's worth taking this into account. Probably more so than most of us do. All right, so this session is session 2. As I said, it is Edge. And I'll explain what I mean about that a little bit more. The overall idea here is Edge setup playbook. That's what ESP is, kind of a play on words. And we're going to go a lot deeper into the idea of an edge today, and keeping one, because that's even more difficult than finding edges, in my experience anyway. So that's the topic for today. And I want to just again do some housekeeping. If you were here last time, we are going to review quickly, again, just to get everyone on the same page. If you were not here last time, some of this stuff is going to go by a little too fast for you. I'm not going to just repeat everything we did last session, which was 2 hours long, but I am going to touch the high points. So hopefully that will get us all in sync and we can go from there. So who am I? I've been trading for 47 years. I put my resume up and my experience up in the last session. Not going to bother with that again, but I have been doing this a long time. I have tried and failed at many ways of doing it, and I've also found stuff that works. And my background is in tech and venture capital. That's my professional background, and as a trainer. So I love teaching, and that's how I got here. TRG, Trading Research Group, is our educational support organization. I've yet to come up with a really good name for what we do, but my partner in that, the co-founder, is Lee Harris, and he is our co-host here today. And he's also an experienced trader, prop trader, business creator, and he has a business with indicators for certain elements of the order flow space called emoji trading. So check that out. Who are you guys in the audience? All right. Again, I'm looking at the names just to kind of take a rough guesstimate of how many of you were here last time. And based on what I'm seeing, I'm going to guess it's about 90%. Just my rough look at the names. So with that in mind, I'm going to go through here pretty fast. If you missed the last session and some of this doesn't make sense, go back and watch the last session. The recording was sent to everybody who registered. Okay, our mission here is to shorten your learning curve as a successful trader. I am not here to teach you a technique or setups or anything like that. I'm teaching a methodology for processes which are critical for any successful trader. One of my trading friends told me recently that he had run into another trader in a bar, and he asked that person just completely off the cuff, you know, what is the most important thing in trading? And he said process. And it's fascinating because that is what you will hear from all successful traders, but you never hear it on Twitter and, you know, in the Furu world of selling indicators. So it's all about process, and that's what this session is about and how to make that work. Limitations, again, I'm not going to teach you executable tradable setups in 2 webinars. So back off of that expectation and strive for this one right here. Strive to be a tabula rasa, a blank slate, and just kind of absorb what we're talking about. It may not fit with what you're doing today. It might take a year. It might be 2 years. It might make sense to you immediately. A couple of people posted in Surfing the Markets and emailed me that they had an epiphany, which is kind of like that when that light goes off and, oh my God, I get it. So, you know, it's gonna impact different people differently depending on where you are on the curve. And so keep that in mind. All right. Important to review the assumptions we had last time because they're critical this time. Hang on one second here. Let me get true full screen for a better visual experience. Okay, and I'll stop moving my mouse around. All right, so markets are auctions. So prices go up and down. Sideways is not a price action. It just means that there isn't any at the moment, if that's indeed what's happening, although it's really rare. Technical analysis is only useful for finding potential, keyword, potential inflection points or places where things could change. Otherwise, you're looking at history. You're not taking into account everything that happened when it happened in history. And so it's really useless as a trading tool other than context, although, you know, people will try to sell you a million different ways to trade the markets technically, and most of them don't work today simply because the order flow software is too smart. That's really the bottom line. And again, I'm scooting through this stuff. I will stop at the end of this first section on assumptions and take questions and conversation a little bit like we did last time. Okay, so same thing's true about trends. From a math point of view, a trend is only true in the very, very shortest interval, not the longest, contrary again to what you're told all the time. And if you think about that, that's just logic, but most people don't apply logic when they're trading. If I have 2 price points, that's a really significant trend because it encompasses everything. If I have 3, same story. There's only 3, it's pretty significant. If I take 3,000 price points or 300 price points and I draw a line through them to get a trend, I am diminishing the importance of every single one of them. So the more there are, the less significant that is. So if I'm looking at a 2-week time frame, that's even less useful, and a 2-month is even less useful than that. So that idea of zooming out to understand where support and resistance, 2 useless ideas, occur is totally wrong. What you want to do is you want to look for places that are places of inflection, where the market potentially could change direction. And then you want to try to understand what the odds are when that happens, because that's truly what an edge is. It's odds. We'll come back to that. So again, charts useless other than for context. I can literally build you a chart that will support any thesis you have. And I've actually done that, and I may do that again later this year. I had a free class I did about 4 years ago. And what I said was, bring your charts, everybody, and I will prove every chart wrong just by showing you another chart of the same thing. And it was so much fun. We really should do that again. Anyway, price-based indicators lag, and they're just showing you a metric, a statistic. You know, a really famous one, the VWAP. Oh, you know, the market will revert to the VWAP. Nonsense. Reversion only occurs in cases where there's less action going one way or the other, but it's a result. It's not a cause. And that's why trading the VWAP doesn't make any sense. It's a metric, it's a measurement, it's the middle, you know. Same thing is true for all indicators. So if that's the case, what is it that we want to know? We want to know what's going on in the auction at the immediate moment. And if that's occurring at an inflection point, something that we may be identified as potential quote unquote support or resistance, or it's S4 or it's R1 or whatever, pick any of those things. The key is what happens when it gets there. If that thing is an inflection point, you'll know it. But trying to predict that it's going to be an inflection point in advance, that's the danger, and that's where most traders screw up. Yeah, I'm looking to buy S2 because, you know, we're going to bounce off of that. Nonsense. If we get to S2 and the order flow, the price action, the auction tells you that there is a bounce there, then you have an edge. But S2 or R1 or the EMA crossing the other EMA or whatever it is, any of those things in and of themselves are meaningless until we see how they're traded. And that's the key point of this entire discussion, really. And because of that, a trade's always a scalp until it proves otherwise. You know, this notion of, you know, waiting for a trade to work is nonsense. If you're in a trade and it's not working, there's a reason why. You know, maybe you're early. Maybe it's not the setup you thought it was. But if you enter a situation intending to remove money from the market and it doesn't immediately start showing you that that's what's happening, then there's a mistake. And you have to immediately adopt this notion here, because that, you know, you can tell me, well, I'm not a scalper, I'm a trend trader, you know, I'm getting in the market for a move for the whole day. I don't care. This point's still true. If you get the entry right, then you will have a really nice intraday trend trade. But if you get the entry wrong, you're screwed. You know, you'll try all that great stuff like averaging into it or giving it time to work, and none of that does work. Okay, let's pause for a minute. And let's look at the comments and questions here. Yes, trading is very dangerous. Never do it, Jonathan. I'm just reading your comment. Okay. Trend is only present when the energy that initiated the trend is still present. Dimitri is writing this, I'm reading. And that is great. That's a really good way to put it. If the energy is continually there, then that move will continue. Otherwise, they're historical. That's great. That's spot on. So the rest of you that are kind of listening on the side, that's what you should be absorbing from this. Yeah, VWAP is exactly an output. I mean, think about what that word means. There are so many people pitching this as a trading system lately, and I'm like, really? No, volume weighted average price. Let's dissect that for a minute. Could that possibly be an edge? Well, it's based on volume. Okay, that's a good start for edges. More volume means more people playing. Okay. So the first word could be an edge. The second word, weighted. Oops. The second, we have the word weighted, or the next word, average. Danger, Will Robinson, if you remember, Lost in Space, right? That immediately makes it useless. It's a weighted average. So how could I possibly make a trading decision off of a weighted average? It makes no sense. But of course, you know, there's plenty of people that'll sell you a $5,000 system. Yes, that is from Lost in Space. That will do that. So thank you, Michael Spillman. So how do you read the energy is the question. And that's exactly where we're going. So let's move onward now that we're all on this. Does anybody have any questions before I move forward about any of these assumptions? We're all great comments, and you guys seem to be exactly where you should be right now. So if you have one, post it. We'll come back to it. All right, so let's move on. So this idea, you know, kind of this play on words, ESP, extrasensory perception. Edges, setups, and playbooks. All right, well, playbook is just a collection of setups based on market conditions. And a process is a methodology of implementing that playbook. So really what becomes the most important place to start are edges and setups, right? And in order to understand a setup, you really have to understand the entire notion of an edge. And I started talking about this last session. And this is really where we're going to spend the time. This is the meat of today, is what defines an edge. And I gave you some examples just from life. And I'm being asked privately, and there's no need to ask privately. Please ask publicly, because everyone's probably wondering, how important is the market profile? It's critical, because it defines places where edges exist. In fact, an edge, using the word edge in a slightly different form, is one of the setups that I use. But here, I mean edge as an advantage. So that's a great question. The person just asked me that, and it's important. And in the next two sessions, I'm going to talk about market profile setups that I use. And that's part of this session too. I'm just not going to be able to go into a lot of detail because we won't have time, but that's what this is about. And that's what we talked about last time. But before we get there, let's finish this part. Okay, so okay, let me clarify. This is a good question too from James. Potential inflection points, if not pivots or MAs, what are they? Okay, let's be really clear, James. A pivot is just a calculated position based on prices of the previous days. So it's a calculated statistic, okay? And a moving average is nothing more than the same thing. It's a moving average of the price. So those are useless. They're pointing out history, okay? An inflection point is a place where the market action changes, okay? And yeah, a battle is a good way to put it, or let's look at it another way. When things are just kind of rolling along, or let's say we're sitting at a price and we're not moving around too much, and trading is just kind of going back and forth. You know, we go up a couple of ticks, we go back a couple of ticks. Okay, that's what traders refer to as balance or value. And it means that the buyers and the sellers agree, James and Mickey. Hope I'm saying that right. Now, price moves when buyers and sellers do not agree. And that's the definition of an inflection point. And inflection points become really obvious visually, particularly if you watch your trading on the dome. In fact, let me grab a quick example of that because it's one of the things I'm going to show later. And this is a good time to do it. Hang on here. Let me just do this real quick because I queued this up for this very purpose. We're getting ahead of ourselves, but give me a second. So to just show you one example. All right, so here's an example of my domes when I'm trading real time during the day. This is the indexes, okay? And an inflection point if you actually watch the auction and you watch the price action going up and down, an inflection point will present itself really obviously because buying and selling shifts at it. And so I'm not going to go into a lot more detail about that right now, but that's the difference, James, between, you know, some statistical thing on a chart. Sometimes they do occur at the same point, but often chart-based or indicator-based events are gamed by traders. In other words, you know, we'll get to a support level, quote unquote, and you'll see a lot of trading push it past that a little bit so that the little retail traders that are trying to buy that will get shaken out of their trades. And this is a very common tactic of algorithms and larger traders that can afford to play bigger positions and do that. And in fact, I don't know if it was in this session or one of the other ones in TRG, but I have a friend that has a hedge fund, and that's literally all they do with $100 million is they game retail technical analysis places like, you know, R1, S1, exponential moving averages, you know, pick anything like that. And what they do is they game them. They try to exceed them by enough that they will stop out small traders, and then they can collect up positions and go back the other way. Happens all the time. Yeah, fibs are a good example. Fibs are a little different because they're a little more interpretive. And they also, you know, because they're percentages, they often show ranges instead of specific price points. So, you know, a fib concept, Jonathan, like ambush zones is a really useful thing to find inflection points. But again, the key is to understand that the notion of support or resistance is total nonsense. What's valuable is the notion of an inflection point. So backing up to your question, James, is that making any sense? Are you understanding where I'm going with this? Yes, no, maybe? Cool, yes, all right. So we're on the right track. All righty, with respect to that, let's go back to the presentation and talk a little bit more about edges and what I mean, and I'll try to give you a lot more examples. But you guys are doing great. I can just see by the comments and whatnot that you're following along. And you know, again, I'm not a traditional kind of webinar instructor. I'm treating this like we're all sitting in a room and I'm looking at you. So I expect some interaction. So please do interact, and we'll go from there. All right. So the notion of an edge, let's dig into that a little deeper. And how does it apply to trading? You know, it's really important that you understand that an edge is a thing, and then applying it to trading is a different thing, okay? So if you didn't hear this, or you're not listening, or you went to get coffee, and this is one of those cases, I do this a lot, where I will literally stop you and say, listen to this point, it's critical. An edge is distinct from the application of the edge to trading. So for example, one of the things that I used to track as an edge was gap fills. You know, and I'm sure many of you have seen the statistics all over the internet. A lot of people have gone back, you know, 300 years and tracked every gap we've ever had. And a gap is just, you know, when we open more or less than the previous close. You know, if we move up by 50 points, we gapped up, and, you know, et cetera. So there's a lot of people that think a gap is an edge. So this is a really good example. It's not. Now, what they have done in the past, and this used to be a good edge, was they would say, well, and I have this statistics book on my computer from 2005. I used to use this, and it worked pretty well. You know, that if the gap was a certain size, so in the case of the ES, the average range over those 20 years is 20 points, 20 ES handles. So a gap of a certain number of points or more would be less likely to fill than a gap of less number of points. And that metric was 10. If we gapped over 10 from the previous close, the odds of that immediately filling were very low versus if we gapped up, say, 5. Okay, this is no longer true, by the way, what I'm telling you. There's too many algorithms and funds that literally game this stuff. So that's an example of there is an edge in those statistics. But not only does it only apply to trading based on the recent action, and what happened 20 years ago doesn't work anymore. So that's a key point, but also it's constantly changing as the conditions change. So an edge can be a useful statistic, but you have to understand that, number one, it's got to apply first of all. And second of all, you have to constantly adjust it because it never stays static. Markets can't stay static because conditions are constantly changing. Okay, so let's go on to an example. Many of you have read this book, the one on the left, Beat the Dealer, or the one on the right, Beat the Market. Beat the Dealer is the first official book on the word edge that I know of in terms of statistics in gambling by somebody who had a background in math. I'm talking about Ed Thorpe. Google him. He's a world famous trader. And basically he came up with this notion that you could beat casinos at blackjack by counting cards. And he was so right that casinos had to change their rules, okay? And he became a hedge fund manager, very, very successful one, and wrote this book, Beat the Market, about applying the same notions to trading. And a whole lot of different cool ways that he implemented doing that. And this is really the basis of everything that I'm talking about in this session about edge, is this idea of finding some mathematical advantage and then understanding under what conditions that advantage exists. So, and I will come back to the questions and comments in a minute, but I want to stay on this notion of the advantage. Blackjack's a pretty simple game. Most of us understand it. So the idea he had here was that in order to beat the dealer, he had to have blackjack or better more frequently at a higher odds, because the rules of blackjack favor the dealer by a tiny, tiny percentage. So the idea was if you knew what cards were left in the deck, you could have much higher odds of getting 21 or getting blackjack. So by counting the big cards, you know, the picture cards and the tens, you could constantly keep an assessment of that. So basically what he was doing was he was constantly building an edge based on that count. And think about that. Every time the cards were shuffled and every time they were dealt, you'd have to look at every card, add them up really quickly, and then constantly change the odds based on that count. So that is the edge that Ed Thorpe developed in blackjack, that he then took that concept over to the markets with Beat the Market. That's the best and simplest first example of a true edge that I know of. And as I've mentioned also, and after this example, I will stop and take some comments and questions. Poker, really good example. I play tournament poker. And if you're familiar with that world, it's a level above this. And again, this is a really, really good point, because at blackjack, you are only playing against the dealer. And that's why professional blackjack players will play at a table by themselves with just the dealer, because the other players are just pain in the ass distraction, and they make it harder for you to focus on the cards because they have cards too. So it's much harder to pay attention. And so a true world-class blackjack player will always play against the dealer, and that's it, without any other players. So that's one thing to keep in mind here. When you're looking at the market, there's a lot of different players involved, and they can have different objectives than you do at any given moment. Think about that. So if you look at a poker game, it's much more accurate way of looking at the market from a perspective of an edge than blackjack is, because it's not as black and white. There's nuance, and trading is much more like that. So if you think about poker for a second, okay, again, this is 7-card Texas Hold'em. If you don't know the game, I apologize. Let me finish this example, okay? 9 people at the table. They deal 2 cards down to everybody. At this point, you flip your cards to you. No one else sees them. Everybody looks at their cards and they decide if they have an edge. The idea is to try to get poker hands, you know, pairs, trips, full house, straight flush, flush, etc. if you know poker at all. So if you have 2 cards, you don't know a lot about what you can do with the 5 best out of 7 yet, but you have a clue. The best 2 ways you could start off a poker hand are with an ace king that are suited. In other words, you know, they're both spades or diamonds or whatever, or with a pair of aces. That's the 2 best hands you can have. Depending on your style, we could argue all day which is better, okay? But even with the best hand, with ace king or ace, the odds at this point are no better than 31% that you can win, because you don't know enough yet. And as the game progresses and more cards are dealt and you see the tactics of the other players, you start to develop a better edge. You realize that your pair of kings is actually a really strong hand, because the way everyone else is betting, if somebody had a pair of aces or an ace king, they would be betting harder than everyone is. So by that little piece of information tells you my pair of kings is probably pretty good. Okay, so that's how in poker, an edge depends on how other people behave. And trading is much more like that than blackjack, because everybody's doing something different. Let's talk about the oil market for a minute. You know, there's people speculating in oil, trading, just trying to make money like you and me. And then there's, you know, American Airlines trying to figure out, you know, what their fuel costs are going to be for Christmas. And so they're either buying or selling oil futures, and they're doing, you know, thousands of contracts, and, you know, they don't care if they execute at 20 or if they execute at 22. You know, to them, the only difference is that it's not 60. So it's really important to understand this notion right here, that the edge is just a mathematical advantage, but without understanding the context of that edge, you really just don't have enough information. And blackjack's an example where you can probably get by with just the edge. Poker is an example where you can't, and trading is an example where you can't. So going back here, the edge is the statistic, but unless you put it into the context of a setup and understand how you're going to execute against that edge, then you're really just, you know, rolling the dice. It's like if you were playing poker, and again, understanding the poker game, you know, if people are going around the table betting, and I haven't seen anybody's cards yet, and my 2 down cards aren't aces or kings, or, you know, I've got a pair of 5s, okay? You know, that's not a horrible hand, but the odds it's going to win this, this poker hand against those other 9 players, you know, as a poker player, I'll tell you, it depends on how they act. So the way of interpreting that in the sense of trading is to take your edge and then look at the setup and come up with quality, a quality interpretation. So we're going to get to that next. Okay, let's pause here and again discuss questions and comments, and then we're going to go into specific examples of setups and edges in trading using my old process and my newest process. So that's what we're going to do after this. All right, let me read the comments. And feel free to hop in here and if there's something I missed, Lee, or if something, you know, we need to elaborate on, or some comments that I should address, please tell me. So, all right, let's see. I'm just speed reading through here. I don't see anything that is burning data. Okay, wait a minute. What's this here? So Dimitri says places where liquidity is high are the slowest points and not inflection points. All right, let's attack that for just a minute. Inflection points can be based on it being really slow and it being really active. But what Dimitri said is correct. There are traders that actually look for things being really liquid as an advantage. There are edges that work that way. You know, for example, high size scalpers. You know, the edge would be in the liquidity. So you know, doing scalping like that at an inflection point would actually be more dangerous, if that makes any sense. So let's see, data mining. What was that comment about, the data mining thing? Let's see, too many filters to get a result. Let's see. Okay, let me, on the gap fill, but never mind. Okay, yeah, all right. So, all right, this is a great question. So I see where you guys were going. So what Daniel is saying here is when you're exploiting an edge such as the gap fill, which is no longer an edge, by the way, the gap fill, how do you assess when the edge has eroded? Exactly. Okay, and the answer is order flow, and that's exactly where we're going. So that's coming up. Okay, so good comments, good questions. Let's move on to the next chunk here. So this was my most recent up until the newest one, which we're working from playbook and process here. And I talked very briefly about this last time. And what I said was that this was an approach that I kind of came up with, I think in 2014 or 2013, after using a flow chart prior to that, you know, with arrows going from one step to another and if then kind of logic for those of you that are flow charters. And I like that approach a lot, but once I got really good at it, I didn't need a flow chart anymore. It was just certain things occurred at certain times. And so that's how I got to this approach. Again, this is a playbook. And then the most recent, I was on my deathbed with one of my rheumatoid arthritis flares and in a lot of pain and watching the market from across the room and taking notes on things I wanted to do. And I thought to myself, that's an old, I forget what comedian that is, but I said to myself, self, and that's what I did. I said, you know, this is too complicated still. You know, I'm all about simple. That Steve Jobs notion of, you know, the iPhone was the idea that if you just keep working to simple, you will ultimately get something, you know, life-changing. And that happened for me when I did the next step. I took all of the conditions. So what I'm doing, Daniel, here is I'm answering your question. I used to try to think of all the parameters that were important at any given second, like during the open 5 or the first hour. Well, chop, correlation, sweeps, volatility, volume, gaps, internals, you know, is it trending? Where are the edges? Is it a range day? This was all, I was trying to figure out all the ways to incorporate that into what I wanted to know for these setups. And so that's an example of having too many variables. And they're all correct. Don't misunderstand me. Reading the correlation's critical, and reading the sweeps. You know, if you're trying to scalp and there's sweeps going on, and again, just by definition, what's a sweep? A sweep occurs when, you know, when one trade takes out a bunch of price levels. You know, so let's say, you know, it's the NQ and there's, you know, 10, 12 contracts bid at the next 4 levels of prices, and somebody comes in and sells 100 and it drops, you know, through all those and 4 more, you know, before the guy finally finds all 100 he wants, and then, you know, we go back to normal. That's called a sweep, and it's very dangerous if you're scalping with size to be on the wrong side of one of those. So you really got to watch out. Now, sometimes a sweep will happen, and the impact it will have on the market is really significant, you know, 6, 8 ticks, and then it'll immediately go right back the other way that it was already going, because that was one trader doing something and nobody else is doing it. And there's a really good example of that in the Friday live session, the May 1 session that I did, where I bought a sweep, where I added a contract to a trade. And we had a problem with that video. We're reposting the video, but look for that, guys. It's a really good example of how you have to understand sweeps, but you can't try to put it into a mathematical formula of when your edge is no longer valid. You have to just intuitively get what the impact on price is. And that takes time to learn and practice. So moral of the story is an edge takes a lot of practice to implement. And I'll come back to that again. So the context portion of this, the left-hand column, as I mentioned last time, this was just about being competent to trade and being humble and getting enough sleep and all that. I took that off because that's a given and I've trained myself. But I encourage you all to have something like that in your process, because if you're not up for trading and you try to do it, you will fail. I promise you. Okay, so context is the next thing that's critical. The second column here, this one right here that I'm pointing above, and all of these were criteria about the context that I used to look at. And it was the same problem I had over here with chop, correlation, and whatever, is it was too complicated to try to suss all that out or assemble all that into one decision at any given moment. So that's why I abandoned this approach. And I went to this approach. And the idea here was to take all of those things like correlation, sweeps, gaps, etc., and just look at it in terms of its impact on the trading day and ignore anything else about it. And that was what was really transformative about this change to this format. And it might not be something, if you don't understand the idea of a process or a playbook, it might not be something that immediately makes sense to you. There's a bunch of people here that are in trading research group and have been through my workshop and have been through a bunch of our classes, and they're in different levels of education about this. So you'll hear comments that may not make sense to you, but make sense to them. So bear with us on that. That's just the fact that there's different levels of experience here. But I'm going to review this again, and in the process of doing it, I'm going to talk about edge. And so that's where we're going to go. And then we'll come back and address all of these notions of, how do you, when does the edge expire, which is really what you were asking me, Daniel, and that's a key point. And then here I'm being asked, are the market profile concepts in terms of market behavior, structure, understanding in Dalton's books? They're valid, but they're valid again only in terms of context. And I'll talk more about what that means. One of the ones that's a key setup for me is the first hour high and low, also known as the initial balance. It's this one right here. And that is a market profile concept, but it's the execution of the edge against that situation. The market profile in defining the initial balance, or the first hour high and low, those two things mean the same thing, or the A and B period also means the same thing. All that it does is give you the market structure. The market structure by itself isn't the edge. It's the playbook that you execute against that structure where the edge appears. And hopefully that makes sense. We will be seeing examples of all of these, and that's James, and that's where we're going to go from free to paid mode. I'm going to try to give you as much as that as I can today, but the next two sessions are setups in detail, and that's the part where you got to be a member of the group. And this next question is really good. Can the IB be gamed? Absolutely. That's exactly the point, Maya. I hope I'm saying your name right. It is gamed, and so that's exactly what we do. It's perfect, Otis, that's perfect. It's first and goal, and there's a million ways to play that. Are you going to do a pitch? Are you going to run? Is it going to be a Hail Mary, everybody into the end zone and turn around? It's what's the play? We know the setup. That's such a good example. The market structure is we're first and goal, and if we score, we win the game. But what's the setup? What are we going to do? What's our edge here? Well, in order to understand that, football, really good example. Let's go with that one. Who are we playing? Okay, are we a running team and they have a great, running defense? Then we probably should do something different. Or are we, do we have a running quarterback who can also throw? That's a totally different ball game. When you're down on the first and goal, think about it, that's the ideal situation, is to have a lot of options. A quarterback that can run and throw, and a bunch of people that can catch, and, linebackers that can take it over. You want it to be that your defense doesn't have an easy way to protect against all the ways you can score. So that's the exact same thing that a good setup is. You get to the initial balance. Everybody knows it's the initial balance. So it's the play that you choose to execute there that will determine whether it's profitable or not. And the approach that we use, Lee is very market structure oriented. And if you look at Trading Research Group, I'll show you our library real quick, where all our educational material lives and where everybody can get to it. Let's see, you're moving stuff around on me here, Lee. Where did you put the live members home? Then it's in there. Okay, there's the library. All right. Anyway, this is all the courses we've had. And I think there's almost 100 now, something like that. And one of the ones that Lee did was market structure. And he went into this in a lot of depth. And there's a whole bunch of different ways to look at it. Traded volume, microstructure in unfinished business, footprint charts, delta, the buy-sell you know, the bid ask at any given moment. So there's a whole bunch of courses about this. For example, Lee did one on why price moves, and this is it, and it's a 1-hour video. So again, I can't go through every detail of everything that we teach and that we practice in this introductory session. So what I'm gonna try to do is talk about this process and where edge occurs and what edge looks like for a couple of different setups. I will show you some chart examples. I've got some queued up for you here, both dome, footprint, and regular conventional retail people charts. We'll come back to all that, so just stay tuned, stay with me. We will, yeah, there's so much depth in this topic. We could literally just teach this every Saturday forever. So I'm really trying to get it down to the nuggets of useful information. So stay with me. All right, so step one in this approach, and again, it's an improvement of this approach, which is an improvement of an approach I've done over the last 47 years. And I've been teaching for about 20 years. And most recently teaching in the workshop and in TRG for about 100 folks, and there's maybe 20 or 30 of them here with us today. So you may see their comments. And I've asked them, to chime in with their experience now and then. We're not doing that to be sales pitchy for you other people. They're just trying to share their experience and what's working for them. So that's why we do that. All right, so this approach says, very simply, what's the first thing we need to understand? Context. Okay, there's a few ways to do that. I use a military example because I really like the idea of this. If you're in the special forces in the military, one of the things they teach you is that when you enter a situation, let's say, you're SEALs and you just got dropped off with a helicopter into Afghanistan, the first thing, the helicopter flies away, everybody just sits still and they stop, look, listen, and smell. You perceive your environment. That's the idea there. And it's a really cool thing to just think about. So when the market opens, stop, look, listen, and smell. Just let the market tell you what's going on. Don't have I'm buying, I'm selling. Put all that out of your mind and just let the market tell you what's happening. Get the context of the action at that moment by collecting information. What information do you need to know? Okay, I used to have all kinds of little bits and pieces, chop, correlation, and gaps, delta, the gap, is this, that, that's what all this was about. And I said, you know what? Let's net that out. This is the net out of that. Critical thing, time of day. Market behaves differently at the open than it does at midnight during Globex. So you have to understand what's going on all around the globe at the time of day that you're trading. Number two, what's going on in the macro world, macro, big picture, geopolitical, economic, news cycle, etc. If you think of this as one big thing, it really is. For this moment in time, okay, it's 8 o'clock at night in California, or it's 3 o'clock in the morning in California, or you're in London and it's noon, whatever. Wherever you are at that moment, all around the globe, what's going on, what news is happening, what economic releases are happening, what markets are open, who's doing what, what's the idiot in the White House tweeting about, whatever it is. That right there is the context of the moment you're trading. If you don't take those things into account, the market will surprise you. For example, if you put on a trade for oil and you forget that the inventory numbers are coming out in 30 seconds, you're gonna get burned. You just can't be right if you try to predict the future that way. And I see rookies doing this all the time. Yeah, I'm putting a buy order really far away and a sell order really far away. And I'm just gonna grab the chop when they announce the inventory. That's just such stupidity. I mean, that isn't an edge. That's going to Vegas drunk, blindfolded, deaf and dumb, with a straitjacket on. I just don't get this kind of thinking. Now, on the other hand, let's say the oil number does come out and it's way off and the market just goes way in one direction. And you watch the energy of that move. And at some point, all those people that were off sides are done covering or buying or selling, and it just stops. Now you have an edge. Okay, that's a really good example because that's the kind of move that you can fade simply because the energy of the move has exhausted. It's not because it's at the VWAP. It's not because it's at the high of last Thursday at 11 o'clock. It's because the energy of buyers and sellers has changed. That's the key point. Okay, It's true of any economic announcement, Alexandros. It's not crude inventories or non-farm payrolls or anything else. It's just that traders thinking that they are smart enough to do that are just by definition Dunning-Kruger. They are too stupid to understand how stupid they are. They are too stupid. They are too unschooled in trading to realize what they don't know. That's called Dunning-Kruger syndrome. And it's critical to mastering anything. In order to be good at something, you have to know enough to realize you're not good at it. Think about that. Most people think that they know enough to do trading well. Go in any group on Facebook and you'll see it all day long. There's currently an indicator discussion going in the Top Step Trading Facebook group. It's hysterical. People are arguing over which indicator, that, it's a joke. There's no such thing as an indicator that's predictive. It doesn't exist. You guys can post whatever indicator you like. Indicators are nothing more than giving you something that's going on at this moment. And that's all. It has, very true. Jonathan said, winning at trading has very little to do with raw knowledge. Let me tell you, in my opinion, what it does have to do with, and then we will move on with the material. It has to do with, and I use medicine as a really good example. We have a couple of physicians in Trading Research Group, and I've coached a few over the years. Physicians are some of the smartest and best educated people I've ever met, by definition. You got to go to, advanced education for 12 years just to get in the door. I mean, after high school and college, right? Not an exaggeration. Medical school, residency, specialty, some of them do it for 20 years. So think about that. Okay. And so that's something where to become a physician in whatever your specialty is, all that stuff does is get you in the door. It's the prerequisite to becoming a physician. You become a physician and you practice once you learn how to actually do that stuff. And so that's why in medical school, they have a methodology. See one, do one, teach one. You watch someone else do it, then you do it, and then you teach it to someone else. And that's a lot of the philosophy of this group. And that's how you learn to trade well. You watch a situation that is an inflection point, you learn how to extract an edge out of that, and then you execute against that edge. All right, so let's go through some examples of that. To get to that, you again need to understand the context. The first one, pretty clear at this point. Then the technical picture and the recent, I've used the term ATR just because it's a good technical term. That's average true range. But basically what I'm saying here, the second contextual thing you need to understand is just what's going on. Right now we have a crazy market with huge ranges. So the ATRs are enormous. And that's much more difficult to trade than a normal predictable market where, value is more or less agreed on. And when we get too far away from value, we drift back toward value. That's much more typical. And so it's important to understand, right now things are very crazy. So that's the context of right now. A year from now, it might go back to being quote unquote normal, or normal might be different. You just have to understand what's normal right now in the last few days, the last week. That's what's critical. And then given the day, that particular day, what's the auction structure? And by that, I mean, what's the buying and selling going on? And that right there, whoever was, Meke, you were asking me about the market profile. That's exactly what I'm talking about, the market profile. So if I were to just look at a footprint of the market, let me just grab one here. I think I've got one. Yeah, this is a good one. So this is a 5-minute footprint chart for NQ and ES. So if I was looking at this, the structure of the market right now is pretty easy to see. We were trading along in a pretty nice little range, and then we sprung out of that. And in the process of doing that, the market decided that was a sell point. So there was an inflection point right there. Let me blow this up a bit, I think. And you can see right up there, we had a nice little range. And then as soon as we left that range, whether it was stops or it was new buyers entering or whatever it was, we re-auctioned, if you will, from this kind of 70 to 65 range that we had been in for each of these 5-minute chunks. We burst out of there and we kind of established a new little range. And that's an example of the market structure. And if you look at these in 30-minute intervals, those periods have letters A, B, C, et cetera. And that's what people refer to when they say the market structure. So that's what I'm talking about here when I say the auction structure. And again, I can't teach you market profile in 2 free sessions, but if you get the macro, kind of time of day, what's going on in the world stuff down, and then you get the, what's happened in the last few days stuff down. So I'm basically converting these to English right now. What's happening in the market today? That's the first one. Second one is kind of what's been happening in the market the last few days, last week, whatever. How far away is it going? How big are the ranges? Whatever. And then the last one is kind of like what's going on right now. If we're in regular session, what are the A, B, C periods looking like? If we're in overnight, how are we trading versus yesterday's session? And those 3 views will give you enough of an idea of the context where you can then look at the price action and you can execute setups. So that's step 1, context. I'm going to pause there and take questions if we have any on context. Let's see, excursions. Okay, excursions, Michael, what I'm referring to there is how far is the market leaving normalcy? So if you were to look at a 30-minute footprint chart, so those would be the normal, period A, period B, period C, if you're following market profile. If the first hour high or the A and B period, first hour high and low are established, and we break out of them, an excursion, an example of that would be, okay, how far are they breaking by and are they coming back in? So in TRG, there's a channel for the first hour high-low setup, which is one of my setups. And I'm going to show this later as an example, but this is an example of what I'm talking about. This is a 1-minute chart of the NQ and the ES from, I don't know what day this was, but whatever. Let's see, April 2nd. And the first hour low was this blue line down here, and the first hour high is this blue line up here. And so it broke it right there. So this would be an excursion when we left that area. And then you see we returned to it. That's one of the reasons it's such a significant point. This tends to happen fairly regularly. So the excursion would be how far away we got from this initial balance, or the opening 60-minute range, or the first hour high and low. Those are all the same thing. Okay, hopefully that answered your question. Am I using a third party? Okay, I'm not going to go into indicators and footprints and whatnot. No, I'm not, but I'll answer yours, Scott. I'm using just one of the shareware ones, Poncho. Is the one I'm using right now. I don't need a lot of depth or detail. In the past, I was using MZ and a few others. Most of them are huge CPU hogs, and I don't care. I see my trading on the dome, so I don't need indicators for like imbalances or unfinished business or any of that stuff. So again, it's not a bad question. It's just the level of depth I can go into for something like today is limited. All right, so once we understand the context, the next thing we want to look at is what's the price action. And for purposes of what I do, I've defined 3 different kinds of price action, and they're really all encompassing. Ebb and flow range is typical, the stuff you see all the time in any instrument. In ES, it tends to do it in an 8-tick range typically when the market's not volatile, and that's just when we do this back and forth. So if you pull up any chart, I'm just going to randomly go grab a chart image here from anywhere. Let's see, these are inflection points. Hang on. You know what? Let's do that in TRG as well. Give me a second. This is the one negative of doing a session like this when the market isn't open, is it's hard to just go grab an example. But if you take a look at, we have a setup called the Open 5, which is another one that I will talk about later. Okay, but this is a good example. Price normally moves in little ebb and flows, like this little spot right here. That's ebb and flow, and that's normal price behavior. And you can see the volume up and down is important, but it generally stays within a range. And then you'll see a sudden change. And this was the opening of this particular day, which was March 20th. And this is a setup we call the Open 5. And you can see how price behavior just changed radically. The volume picked up and it got much more active. So that's what I'm talking about here when I'm saying ebb and flow range. So that's the real quiet back and forth. Price discovery was the second thing I showed you there. And that's just where it's really aggressively and violently going in both directions. And price discovery is just really simple. It means that traders don't agree. And people are putting on bets in both directions. So the market, you know, when you see inventory numbers come out or the FOMC comes out, that's typically when you'll see price discovery. And in general, it's not tradable, so you want to avoid it. But it's also a really good harbinger, for lack of a better word. When you have price discovery, usually there's really good setups right after price discovery. So it's a warning that good trades are coming. But generally trying to trade price discovery is pretty stupid, because even if you get, you know, if you get the side right, you know, you're short and that's the right choice, or you're long and that's the right choice, where you put your stops and where you put your targets, it's impossible. You know, if you just go back and look at any video in our library of any of the price discovery events, you know, the NQ can end up with a spread between the bid and the ask of, you know, 8, 10, 12 ticks. It's crazy. So, so be cognizant is the word I'm looking for. Be cognizant that this is both an opportunity and a warning when you see this. And so it's so different from this, but it often precedes this, H-Momo or high Momo, which is the same idea, but it's basically going in one direction. And that is where most of the opportunities in trading will occur, is either in high momentum events, or when price discovery becomes high momentum, or when ebb and flow becomes high momentum. Okay, so the idea that I stumbled upon here lying in bed in pain was, okay, if I get the context right, in other words, as long as I understand the time of day and what's going on in the market, and you know, where the boundaries are for the periods, if we're in regular trading hours, and you know, how far we've excursioned away from those, and you know, that pretty much will give me a good idea of what's going on. I don't really need to know anything else. You know, if there's a gap, I will know it because it will fall into that structure. And if there's correlation, again, I'll know it because it will be part of this picture. So as long as you understand what this means, and then you evaluate, okay, given that, what is the price action? You're then ready to go look for edges and look for opportunities. Yeah, Jonathan, I was trying to come up with a good word for excursions, and there isn't one. Michael says, head fakes are price discovery. Yes and no. The head fake we get at the open 5, by definition, yes, it's price discovery. But you know what? It's really more psychological than that. Typically, head fakes occur pretty common places. You know, and a head fake, just for the rest of you, that's when the market does something for a blink, for a split second, and it looks like it's going to go one way, and it looks like there's a decent amount of energy. But that particular move just totally reverses. And in the open 5 setup, we see this very frequently, where the first move is a head fake, and it might last 10 seconds, 5 seconds, and the real move comes after that. And I don't know what the real reason for that is. I do have an opinion, you know, and as I said last session, you know, most educated traders will have 3 opinions about any topic, and most smart, you know, good critical thinkers will have 3 opinions about anything. And so I've taught myself this idea. So whenever someone says to me, you know, is this true or not? I say, well, there's always 3 options. You know, there's it's true, it's not true, going one way or the other, or there's nothing happening. And it's one of those 3. So the head fake, my opinion of what a head fake is that it's an emotional thing. It's like it takes everybody in the market a beat to assess what everyone else is doing. So that's my assessment of what a head fake is. It's like if I'm looking at the market and I say, okay, let's assume I had infinite size. I could trade as many contracts as I want, and I can take losses as big as I want, you know, while I'm in a trade. If I look at the open 5 from that point of view, it becomes obvious when the head fake happens, because my intuition when I see it is no, that's wrong. And then it'll either continue and be right, in which case it wasn't a head fake, or it will turn. And you see that a lot. Next 2 sessions of this workshop, so the next 2 Saturdays, which you do need to be a member of TRG to come to. I will capture some live examples of that or show them to you in the video because they're important for the Open 5A setup, which is one of my favorite setups. And so we will do that. And one of the things we're also going to do in this workshop is we will do a live session. I haven't scheduled it yet, but I decided to add it. Just to talk to that. These are the 4 sessions that are scheduled. We're on the second one right now. These 2 you have to be a member to come to. Somewhere in that same time frame, I'm going to add at least 1 live session during the market, when the market's open, so we can go take a look at this stuff live. So I just haven't figured out when to do it yet. All right, so if you understand price action, you understand the context, then you can come down here and say, okay, given those things, what setups are out there and when do they occur and under what conditions? And so that's what these setups are about. These are the opportunities or the setups that I look for. Some of them involve market structure and market profile. Some of them don't. Some of them are just patterns that I've seen over the years that I've learned to play with. And so that's what I'm going to do the rest of this session today, which will be about the next half an hour or so. I'm going to go through some specific examples of specific setups and how you find the context and the price action for that particular setup and what it looks like on the dome and what it looks like on a footprint and what it looks like on a chart. So that's where we're going next. Pausing for questions, comments. Let me read back here. Okay, let's see. Do I have a set of scenarios as to what could play out? Okay, oh, this is a great question. Do I have a set of scenarios or what could play out in my mind before the market's open, or am I just watching order flow? I used to do that. You know, I used to be one of those people that thought you had to have a plan before the open. And I hope I'm saying your name right. Meke, I hope that's correct. And that worked 15 years ago and 10 years ago. I don't find that it's useful anymore because what it does, it creates bias. And what I'd rather do is have my playbook in front of me, and then when we get to any of the playbook setups, look at the order flow and see what the right answer is. And that way I don't have to think ahead. So, you know, my market prep that I used to do, you know, prepping for the open, I used to spend a couple hours. Now I spend 5 minutes and I'm better at it. So I hope that answers your question. Yes, what Amy said is absolutely correct. Inflection points are areas that you can watch and see what the order flow does when we get there. And then we already know based on that what our execution is going to be with an if-then kind of a logic. That is exactly correct. And that's why I used to use a flow chart for this because, you know, I would get to, you know, well, what time of day is it? It's the open 5. Okay, then I should go to the open 5A setup and then I should go look at the order flow, you know. So it lends itself to flow charting very well if you think that way. But what I found over time, and as I did it more and more, was, you know, the flowchart's just a training. It's training wheels. It's an exercise to get me used to just focusing on the setups that are available based on the price action and the market conditions and the context. So this made much more sense to me. And it so far does to the other people that approach the market this way in the group, because it's just simpler and faster. You know, real quickly, what time of day is it? What's the context? What's the auction structure? Okay. Is the market ebb and flowing? Yes. Okay. Then we can, is the market in price discovery? Yes. Then is the market in high Momo? Oh, yes. Then we, you know, it's real simple. And then there's just 2 modes. You know, some trades, you have to give them more time and you've got to enter them more slowly and scale into them. I call those wait mode trades. Because they might play out over, you know, an hour. And then scout mode trades, you know, those better work instantly, and I'm going to go in with everything or nothing, and I'm going to go out, you know. So it's a different mentality. And if what many traders struggle with is they're scalpers, but then when they try to switch to an intraday kind of waiting for the trade to develop trade, they can't manage it because their mind is still in scalp mode. So I solve that with having every trade be a scalp unless it proves otherwise. And if it turns out it could be, you know, more of an intraday trade, then I try to chill into the trade with more of a wait mode. But I always start by thinking this way. So that's an important little thing to consider as we talk about these. And so what I did here on this was I coded which mode applies to each one of the setups. So if it's pink here in the mode box, that means it's a scalp mode trade. If it's blue, that means it's a wait mode trade, and you have to approach it differently. And so this is part of the questions that are being asked right now in the chat, and I'm going to go into that in just a minute. Okay. I just wanted to scan the questions and make sure everybody was caught up. And yes, Felipe asked me, can a 2 or 3 second chart allow you to see and understand the open five behavior? Yeah, it's actually really visible on a 15-second chart. That's the one that I recommend using if you have to use a chart. My approach to trading that, and any trading, excuse me, sorry, I'm burping from my coffee, so my apologies. This is what my main screen looks like. And so I use a very, very fast chart. It's not always at 45 seconds. During the open 5A, it's typically at 5, 10, 15 seconds. And because I literally want to see the transition from one point in time to another. That's why I don't use tick charts, because they're compressing time and I don't want time compressed, or range charts or any other form. I only use time for this. And then I have a footprint up here because I want the opposite. I want it to compress time into auction behavior, so I can see, you know, the trades on the sell side and the trades on the buy side, and then a little bit of a delta summary of that. Like for this 145-second footprint, this down here is telling me that the delta was 185 on the buy side, and most of that was actually this 151 right here at 45. So you can see 45 got bought. So, you know, whoever sold down here got caught on the wrong side and stopped out. And now we're back in what looks like ebb and flow here. And you can see the same thing here. You know, we're back where that little ebb and flow range was after a couple of attempts to have an excursion away from it. So, and again, you know, without the market moving, it's really hard to explain this. Just trying to show you from really broad strokes what it looks like so that the context of this document makes sense. And that's all we're doing. We're just not going to be able to go farther. And we've already been at this an hour today, 2 hours last week. And again, if you don't see that I'm just scratching the surface of some really good information, you know, then this might not be, you might not be ready for this stuff yet. You know, it might not be where you're at. If you do see that, then, you know, you should definitely check us out in TRG, because this stuff will really be valuable to you. And we go into painful levels of depth, and there's 100 videos with and yeah, I was wrong, it's not 400 hours of video, Lee, it's like 290 hours of video. So, and there's around 100 there, I think, now, give or take. All right, so pausing for quick questions if there are any. Put them up in the chat. Lee, interrupt me if I've missed anything. If I haven't, I will continue and talk about a couple of the setups within this context, and I'll show you some examples. Darren says, what do I lean towards when the market is right on the line between HMOMO and ebb and flow? Depends on the context, Darren. Where is it doing that? If it's doing that at a really good inflection point, first hour high, first hour low, you know, then I'm going to lean on the high volume nodes. So that's the short answer. I look for where the volume was. So let me go on for a couple of considerations, and then I'll show you some examples. Okay, so let's talk about edges, question mark. What is an edge? Is it edge support? No. Is an edge resistance? No. Is trend an edge? No. Is if your indicator, you know, Google on a 34 period is greater than your Google indicator on a 46 period? No, that's not an edge either. None of those things are edges. What is an edge? An edge is at an inflection point when you have some piece of knowledge that gives you probabilities that are better than 50-50 at that inflection point. And sometimes the edge is nothing more than reading the order flow, but typically it's an order flow behavior at the inflection point that will lead you to believe that there's that advantage, that statistical advantage, okay? And so I will show you a few of those. All right, this image on the left here is an example, and I grabbed that right out of our TRG, the Trading Research Group Slack. We have this great Slack with all kinds of channels of conversation. And this particular one is JM is me, Jeff Mayhem, and first hour high and low. And so what I will frequently do here, we don't call trades or price levels, but when we get a setup like that, I will say something like this. The first hour high low, in other words, the initial balance is in play. That's what this post was. And what I meant was Okay, it got established. You know, we established the first hour high and low in the NQ and in the ES. And on this chart, it's this blue line. Okay. And, you know, again, this isn't an indicator based on the past. It's literally just calculating this as it happens. So as soon as, you know, in my time zone, as soon as we get to 7:30, okay, that my first hour in California is from 6:30 California time to 7:30. So that's right there where the first hour is established. And right here, you can see the breakout of the first hour. And this was a golden opportunity to get long. Why? Well, it's really clear. The market was ebbing and flowing in this range until we got there. And if you can't see on these two charts that price behavior changed right here, then you know you have no business trading, because you know, ebb and flow, ebb and flow, ebb and flow. This entire little area here is ebb and flow. Same thing in the NQ. So is there correlation? Yes. The two indexes are doing exactly the same thing from let's call it 7:12 to, let's call it 7:30. Okay, so I'm talking about this area right here. Same thing right here. That's ebb and flow, back and forth. You know, nothing much going on. We're in a range. We're at value. There's a bulge in volume there. And then what happens right here? And why is it different? Okay, and bear in mind, guys, we're looking at a 1 minute chart. You know, that looks like, oh, that's a really fast chart. No, it's actually a really slow chart. If you were watching this on 15 seconds, you would have seen this event unfolding. But basically what happened was everybody who had been watching the first hour high, in other words, the initial balance that everyone agreed was value in the first hour, suddenly didn't agree anymore. Whatever the reason was, doesn't matter. I don't care if there was news on the tape, or, you know, Twitter said, Trump said something, or, you know, whatever. It's irrelevant. And, you know, having a news feed is useless. What matters is that the price not only changed, but it changed aggressively. And look at the deltas down here. This is what ebb and flow looks like. Back and forth, back and forth, back and forth, back and forth. And then boom. I mean, you know, you don't have to be a brain surgeon here to understand that the behavior of the market has indeed changed, and go with it. You got H Momo long, and the only thing to do is to go with it. Okay. And you had plenty of opportunities to do that over the next, you know, what? 1 minute, 2 minute, 3 minute, 4 minute, 5 minute, 6 minute, 7 minute, 8 minute. You had 8 minutes to play this, but if you were watching a 1 minute chart, you missed it. If you were watching the tape, if you were watching your dome, if you were watching a 15-second chart, you would have seen this trade happen and you could have jumped in. So that's a really good example. Inflection point, breakout long. Order flow would have been telegraphing all day long that the buyers were overwhelming the sellers here, and that would have been a really good play. What does that look like in the playbook? Okay, that is what I call H Momo. That particular one was also the first hour high and low, remember? Okay, this is the first hour high and we broke it. So let's look at those two setups. And let's look at the context first. Literally, just think, if you were trading this right now, what would have happened? Okay, time of day, it's the end of the first hour. Whatever news was going to hit, you know, whatever announcements there were from economics or whatever, most of those occur either right before the open or they occur in the first half an hour. By the time the first hour is done, with the exception of oil inventories and, you know, some oddball stuff like that, news is pretty much over. So at this point, the auction structure of the day is all that is really critical, and the technical picture, you know, what are the excursions around that? So if we look at this chart, you know, this was the open 5, again, aggressively got bought. That's it right there. Also is on this chart. The pink lines are the open 5 trade, but let's skip that one and talk about the open 1 hour, the opening 60, or the first hour high and low, or the initial balance. Those are all the same thing, okay? And so what happened here? The market opened up out. It had been in ebb and flow right before the open. It opened really aggressively. A lot of buyers for whatever reason. And again, the indexes were perfectly correlated. They typically are. You know, the exception is during earnings season, or, you know, if there's news with one big stock like Google or whatever, then you'll see them not correlate. And that's important if that's not the case, but most of the time it's correlated. So then you see that, you know, the buyers got overwhelmed by sellers. So was that a head fake? No, not really. That was just, whoever rode that up probably taking profits. Look where it stopped. It stopped right back at the same area it had been consolidating at right before the open. And that's very typical. So that little high volume area right there is where that ended. And then we kind of just got this kind of nonsense of low volume. On my NinjaTrader platform, the width of the candle represents the volume. So these little skinny ones are low volume, and the wide ones, whether they're up or down, are higher volume. And in this case, up on high volume, down on high volume, and then it just got really quiet, right? And yeah, we drifted up, but who knows what we did that for. We established a high volume node up here in the NQ. We didn't really do that in the ES. It was much more symmetrical, but then there was one up there. And so that's interesting. That one was a little lower. That might have been a clue this move was coming. Who knows? And then look what happened right here. We saw a complete behavior change, as I mentioned a few times. And so the inflection point defined itself for us as the first hour high. Keep that in mind. So the market structure up until this point was pretty balanced with a little bit of a bias that we were at the top of that. So, definitely an inflection point. We're either going to go back down into the range or we're going to break out, and break out is what we did. So let's look at this again. The HMOMO is how we left the first hour high. So that was scalping mentality. The price action was high Momo. It always is for high Momo. It can occur at any time of day. We don't care. So we saw it happen there. It can occur unexpectedly. It did in that instance. Rule number one, you just never fade this. You go with it. And it's often a good idea to use a market order to get in because it happens unexpectedly. So if you did that here, as soon as this move away from the first hour started, so you would see the aggression, you'd see the volume, literally just grab it with a market order long. And after that, you have to manage your risk and manage your profits. That's a different conversation. But that is the setup and that is the entry. And that one was HMOMO, but it was also an edge of the first hour high. So let's go look at that setup and see what the criteria are there. Okay. The opening 5 transitioning into the first hour. What I mean by that is as the first hour forms, the opening 5 becomes less important and the opening 60 becomes more important. But you can see the opening 5 here was an inflection point until the opening 60 formed. See, because this is painted based on the fact that it already was there. So look at this from the opening 5. Okay, that occurred from 630 to 635. So that was this range. That low held, it drifted up to the high it had established earlier. It shimmied around there a little bit, but it held it. That could have been a place to get long based on that setup. Remember, that's this right here. Opening 5B, that means after it's established. Again, I'm not going to have a lot of time to go into that part of it. I will explain the rest of this in just a second. So as that was happening and it broke this, that's where this all became true. So what does that mean? Okay, this is more of a wait setup. You might have to give it a little time to develop. And you can see it did take a little time, but once it went very aggressively. So oftentimes you can scale into a trade like this. Maybe get long with one there. And then when it breaks out, put on another one. And then maybe on the first pullback, take one off. And then maybe if it starts moving again, throw another one on. Managing risk and profitability in scaling is an art form. And again, I don't have time to go into that today, obviously, but we'll talk a lot more about that in the next 2 sessions. So again, for the first hour high and low, the price action you're looking for there is high momentum and ebb and flow together. And that's exactly what happened. See, you had ebb and flow, and then high momentum leaving that area. So that's very typical. You'll see that in this setup. And the setup only occurs during regular trading hours, RTH, because by definition, there is no first hour overnight. So you can use it for any instrument as long as that instrument has a regular daily trading session. Anything that trades 24 hours without a regular session, you wouldn't want to do this in. But, any of the major market indexes this applies to around the world, and any of the major commodities as well. Okay, the conditions you're looking for are the wave volume and the auction structure. Wave volume is simply these numbers up and down on my charts. That's one of the things I really like. It's a Wyckoffean concept. Um, Wyckoff was a tape reader back in the 1900s, early 1900s. You know, literally one of those guys that sit there looking at the ticker tape, and he had this notion of price action too. And I really like his ideas. And one of them is wave volume, and it's a real easy concept. If you look at the volume up and down here, here's a really good example. You know, we went up 97,000, we came back 63,000. So that right there is a bias toward the upside. And then we went up by 34,000 and we only came back 9,000. So basically the moves up are showing more volume than the moves back. In Wyckoff, that's called a spring behavior. And that's another one of my setups. Guess what? It's called a spring or an upthrust. It's a scalping mentality. It again occurs at the transition between high Momo and ebb and flow. It's a trending situation, and you can only look for it on one time frame. So here we're watching a 1 minute chart, and we see a perfect setup of a spring. And what that means is we had a high volume move up, 34,000. We pulled back on 9,000. That's your long entry right there. Because the market just told you that the buyers are more aggressive than the sellers. And the next thing that happened, we sprung up on another 35,000. We pulled back on only 12. Another buy entry signal right there. And then we went up on 26,000, pulled back on 16. You had another buy entry there. And again, notice how these are occurring at high volume nodes. That's your filter. You know, if that's occurring around a high volume node, what you've done is you've used the edge of a spring behavior to look for low risk entries. What does that mean? Let's say I bought right here at 24.55. If I'm wrong and it goes to 24.50, it's really obvious right away. But notice how that never happened. You know, if you were buying this behavior, you were never wrong. And then, you know, of course, when we got to the first hour high, not only did you get, you know, your little 2, 3, 4, 5 point springs, but you got a whopper. You know, this one went what? Even if you got late, let's say you didn't even get in until the first pullback at 24.90, this puppy went to 25.20. 30 handles, folks. One setup based on one set of conditions, based on your edge that you know, based on market profile theory, that the first hour high is by definition an inflection point. If it gets bought, buy it and hold on for the ride. How far it's going to go, you have no idea. You just have to play it, take what it gives you. Okay. Pause. Deep breath. I just showed you HMOMO, an introduction to the Open 5A. I didn't really go into it. Most of that was about the first hour high and low and a spring up thrust. Those are 4 of my quote unquote opportunities or setups that I trade. And you could pick any one of those and make a living just doing that. Lee has a really good class on how to use the first hour high and low in one of his setups. And again, I want to just point out in TRG. So again, this is in our library on our homepage. There's a really good session on using trade setups based on market structure that Lee did a couple of weeks ago. And he goes into this in a lot of really cool detail. So I recommend checking out that one. And another one that is useful, well, all of these are, but the idea of unfinished business in order flow microstructure. This is a way of understanding what you're looking for in the order flow so that when we get to a spot like this that I was talking about here, when we get to that spot, this is just easier to see. Hang on, come on. This is easier to see blown up. You'll know what you're looking for. And Lee did a really nice job in this video of talking about that. And I'm not going to show you actually what he explained, but I just want you to hear an example of a totally different teaching style. Can you guys hear that? Are you hearing my, you don't? Okay. Well, anyway, Lee, that's hard for me to turn on and off, but Lee did a really good example and it's in his English accent, which is much better than mine. And it's a really good way to understand from a footprint, market structure, market profile point of view, what's happening here. And yeah, there are some free videos there, but we're not referring to that, Jonathan. Yeah, there is audio in that video. You guys just can't hear it because when I share my Zoom, it doesn't grab my video. But my point in showing you that is that there's a lot of educational material in TRG about how to understand these points. And my point here is we just don't have the time to explain it to you. There's literally hours of video you can study about it. So what we've gone through so far is the notion that, yes, there's all kinds of different criteria that are important, but if you break that down into 3 chunks, number 1 chunk is what's the context of what's going on, and I told you a couple of ways that it's important to assess. And then you get the technical picture and the recent excursions away from that. You can then take the price action and you can bubble that down into certain kinds of opportunities. Those opportunities repeat themselves pretty much every day. And because they repeat themselves every day and we understand the nature of them, like what a first hour high low means and how the auction structure and the wave volume can give you clues about the order flow, then the bottom line is just learning what it is you're looking for. And then once you have that, then you in fact have this setup, and then it's just practice. So again, in an hour and a half, I'm trying to give you as much detail as I possibly can without overwhelming you, and demonstrating, that once you do get the meat of this, there's actually some really cool stuff you can put into practice. And with that, I'm gonna, I think, pause here because if you have good questions, I'll be happy to spend more time on questions and elaborate. But going into new material at this point, an hour and a half in, probably not a good idea. I do want to point out that for good order flow traders, the place to identify this is on the DOM and not charts. It's very clear if you watch it happening as it happens. This is Jigsaw I'm showing here, but in TRG, we're kind of platform agnostic. We have people that use Sierra charts, and I use Jigsaw and NinjaTrader. The platform is just a toolbox. It's about whatever tools are useful for you to see, this exchange in the market as it happens real. And in the next 2 sessions, I'll talk more about that. And as I promised, I will do a live session for this workshop, but it will not be until the next 2 members. So if you're here for the free, I apologize, but you're not going to get that one. We'll schedule it as soon as we see how the weeks are playing out and what the market's doing. All right. Questions, comments, clarifications about anything we did today, about anything on here or anything at all. Lee, please chime in if I missed anything or if there's stuff I should expand on. Russell asked me, do I use spring and upthrust on a 15-second chart? Great question. And the only rule of the spring and upthrust setup, Russell, is that you just have to pick one time frame. It doesn't matter what it is. You can use it on 15 seconds. You can use it on 5 minutes. The guy who's Trades About to Happen book, which is a great book, by the way. I post his charts occasionally. I'll show you the book I'm talking about. It's called Trades About to Happen by a great guy and my friend David Weiss. He talks about a whole lot of different ways with a lot more detail than I do. And if you really want to dig into that, this book is useful. But the piece of wisdom I will give you from my experience is that, David had to write a book. There's a lot of detail in here you really don't need. But David likes 5-minute charts because he's kind of a intraday trader. I'm more of a scalper, so I like faster time frames. And again, from a mathematician's point of view, and yes, I am a trained mathematician. I have degrees in economics and business and yada, yada, yada. It's always more accurate the faster you go. And, people are always like, what? That's so opposite to everything you hear. You have to use longer time frames. I know. That's an example of the furu, the fake gurus on the internet. Zooming out and looking for, support on the longer term time frames is total nonsense. Nothing could be more deceiving and more bias creating than doing that. The indicator on the bottom of those charts, Christine, are you asking about this one over here? That's the built-in delta indicator in the lifetime version of Ninja. The top one is the cumulative delta and the bottom one is just bar by bar. So that just means, how many orders went by on the sell side, how many orders went by on the buy side. And if you don't understand what the buy and the sell side means, you know, you need to pick up one of the books about auction theory. Trades on the bid versus trades on the ask. Lee did a really good session, as I pointed out a minute ago, about, you know, why price moves. It's in the library about that, to understand that better. Okay, let's see. Can I give one example on the dome? I can't, James, because the market's closed. I don't have if I open my dome, there's nothing happening right now. And I can show you a picture of it, but that's not going to tell you anything, because it's not moving around. You can see high volume nodes on a static, you know, image like this. You know, this was a high volume area right down here. And, you know, this was another one up here, but I can't show you trade examples because it's not moving. So, you know, I apologize. But there are some good ones in the, you know, there's hundreds of them in the library. And I have done a couple of free sessions in the past where I showed that, but I wouldn't know exactly where to point you. Lee, please, you know, tell me if there's any questions I missed. That's a great idea, Amy. Why don't you do that? Let's see. Jerry, is he in this session? Yeah, he is. That might be a good project for you guys, for our ambassadors and cruise directors. Okay, Lee, so I guess there's no questions I'm missing.
There's just one I see from Joe, and I'm not quite understanding the grammar in it, but it's saying I'm going to guess at this, when you look at what is going on, what are examples of the what, and how do you recall that when you get to the setup for decision making? I'm not really I don't totally understand it, but okay. I guess it's how you filter through your setups based on what you're seeing.
Yeah. Please clarify for us if that is what you're asking, and I will answer that one, assuming that was the question right now. It's a good question. I'm not filtering. What I'm doing, and I used to filter. Okay, so I used to think in terms of. And David also, yes, David, you mentioned something about tagging the videos. Perfect idea. So we're going to throw that one at you. And Lee, let me just throw a to-do for you and me. Why don't we talk about maybe giving that as a project to David and maybe making him some sort of worker for doing that. So you and we can come back to that. I think that's a good idea. Yeah. All right. So the idea here, I used to kind of think in terms of filtering and, okay, how do I use what I see in the pre-market prep to my trading is what Joe's asking me. All right. I do it in the following way. I look at what's going on in the world, and I do that by looking at the clock and economic events that day. And, you know, if Trump is tweeting about any nonsense or whatever it is. And once I've done that, I just kind of take a 10,000-foot view. What could happen? What's going on? An example of what? Okay, I'm still not sure what you're driving at, Joe. I just gave you one. You know, oil prices are down, and that could create a war in the Middle East. Therefore, if what are the countries that let's use Africa as a better example. Most of the oil producers in Africa the country will disintegrate into chaos if oil stays where it's at, because the entire regime is supported by the price of oil. Nigeria is a good example. So if I was scanning the news this morning right before the open and I saw that, you know, there was military action in Nigeria and I was an oil trader, I would immediately know that could potentially impact oil price today. That's the kind of thing I'm talking about. But, you know, there are no specific checklists, because it depends on what markets you trade and what indicators, what markets you trade and what setups you're using within what price action you're looking for. You know, for someone that's a scalper like me, anytime we're right after an economic quote unquote news event, I'm immediately looking for opportunities, because that's scalper's paradise. So what's the terrible business plan you're referring to there, David? Not sure what that was referring to. Please elaborate. Anyway, so let me just walk you through one example. And let's just, and again, we're going to do this in the next 2 sessions for all these setups. And, there's just a limit of what I can do in 2 free sessions. So, bear with me. I'm doing the best I can. So let's say, it was 5 minutes before the open. I just rolled out of bed. I'm drinking coffee. Okay, there's no news coming out. Everything that's economics already been released. There's nothing coming out in a half an hour. Let's say the last couple of days, we haven't really gone anywhere. We're in a range. The auction structure supports that. What am I looking for? I'm going to look for us to break out of that range on high momentum based on what I just told you. That's the setup I'm going to be looking for. So I will be looking to let the opening 5 tell me what the tail of the tape is. So as we open, if there's high momentum at the opening 5 and it's in one direction, I'm going to jump in long. And I'm going to do it with a market order, and I'm probably going to do it with a couple of contracts. I'm going to let it rip. And let's just say that was one of the days where the market just opened up and crazy went one way the whole day. And we ended up closing at, S&P of plus 70 points or, Dow plus 500. That's happened a few times in the last few months, right? All right. The only thing you needed to get that trade, there's no support, there's no resistance, there's no this cross that, none of that nonsense. That stuff is nonsense. All you would need to know to take that trade is what I just told you, okay? We were coming out of conditions where not much had been happening. And that trade would have manifested itself to you just by following this outline. We would have been in that range. The people looking at support and resistance would have been asleep. The order flow traders would have been waiting for momentum. The second the momentum started, the order flow traders would have got long. You would have seen something very much like this kind of a chart behavior. Another one that would be typical, and again, I'm going to show you a lot of examples of this in the next 2 sessions. But one of my favorite things that happens is just when the market just goes crazy in one direction. And I don't know if I really have a good chart to show you that. No, I don't. You know what? I do have some good images, but I just don't have them ready to bring up. I have them ready for when we talk about that. But there's a setup that occurs called a flip. And we had one a couple of days ago where there's an overnight move that's kind of weak. And you'll see a reversal right at the open, and then it will just wickedly go the other way. If you go back and look at your own personal charts, you'll find that setup. If you look at the TRG Slack, I'll show you where that would be for us, because I did post it there. So again, just from here, it's called a flip. And in Jeff setups, remember I'm JM, there's flip. And here's an example. Looking at a possible flip, we got the flip. Okay, so this is what I was posting saying that I was looking for a flip. So here's a perfect example of what you're asking me. This is before the market opened. This is the last couple of days. So remember, again, that I'm looking for context. Whoops, wrong way. So the last couple of days, ebb and flow, ebb and flow. We broke out, then we kind of consolidated, and we're up here on low volume overnight. Okay, so that's what happened. That was kind of what I was pointing out. This is a 30-minute footprint chart showing a similar setup. Okay, so this was all at 4 a.m. I posted that, right? Can you see that? Let me blow this entire thing up a little bit. That might make it easier to see. Okay, so I posted this at 4 a.m. okay, on Tuesday, which is when this happened. And I posted, okay, we're correlated and we're up in the pre-market, but the volume was pathetic. The ES was only at 200,000 contracts. That's very low, okay? And then lo and behold, that is what an overnight flip looks like. So remember, this is where we are. That was what I posted, not this, okay? Let's go back, all right, just to refresh your memories, all right? This was the chart I posted. I said, odds are overwhelming. That's my edge right there in the flip setup. Odds are overwhelming today that this little stupid pop-up on low volume won't hold, okay? That's the setup. Result was that, okay? 29.10 to 28.85. Huge move. It did exactly what we thought, and it did it right on the opening, and it never looked back. That's a perfect example of how my pre-market prep and then one of the setups, and what you would have seen here is, we were looking for that setup. I posted it an hour before, 2 hours before the open. As soon as it's set up, what you're looking for is overnight transitioning to the regular trading hours, a large counter trend, CT is counter trend, low volume move during the overnight. I mean, this was a perfect overnight flip, worth what? You know, even if you got in late, let's say you didn't even get in till what, 29.05 would have been a really late entry here. You picked up a cool, you know, 20 handles. I'll take that on any given day. All right, we're going to end it there, or stop it there, take questions, comments, and I'm going to go to the very end one more time and just tell you what you got to do if you want to come to the next 2 sessions. TRG is the library that I just showed you where all this stuff is. This is our members library. There's so much material. You could start watching it right now and watch it for 2 weeks on all these topics. We're in the process of tagging it, as we were just talking about. We're going to make some clips from that. That's a great idea. We have sessions every Monday. We have workshops all the time. Those are multi-session events. We have clinics. Those are shorter multi-session or really deep dives into one topic, like Lee did a really good one on delta. Just what does delta mean? You know, I posted this image here a minute ago of, hang on one second, of my chart, and I was saying, yeah, this thing down here is the delta, and that's that 185 contracts on the buy side. What does that mean? Why is it the buy side? This entire clinic was all about that. How can you tell by watching the market trade? How can you tell what is going on and what traders are actually doing? And Lee went into a really good session on that. So if there are any other questions or comment, whoops, I closed my presentation, sorry. Give me a second. I will reopen it. Okay, so where we are is down here. If you want to go further with us, and we would love to have you, it costs 99 bucks a month. You get the whole library, you get everything we've done, all you have to do is go through it at your own pace. We're available for questions. Lee is in the UK. I'm in the United States. We're both there sometimes. Sometimes he's there, sometimes I'm there. There's another 100 members of varying levels of experience. We have professional traders. We have new 20-year-olds that are learning trading and are getting really good at it. So you know what? It's just a really cool thing. And these numbers are out of date. This is actually more like 100, and this was a slight error. It's actually about 280 hours is what I counted. So I'll have to update that. But this number is bigger. So we just haven't kept track of, we keep adding stuff. Anyway, all right. Questions, comments, concerns, anything. I'll stick around and answer them as long as I have time. Okay, do I ever use supply and demand in my trades? Well, I just finished explaining how I do that exactly. Yeah, it's order flow. So what do you mean, James? You mean, are you talking about some like third-party indicator for supply and demand that, you know, somebody's charging $500 for? No, I don't use that. I use order flow. Absorption, what does that mean for you? Define absorption. Go ahead. I'm waiting. Go ahead. I'm not putting you on the spot. I'm serious. Everybody has a different definition. What does absorption mean to you? That's why we don't use terms like that in TRG. We just talk about buyers and sellers, and you know, it may or may not be the correct term at any given point, but people tend to get really into selling definitions of terminology. Price moving down, getting stopped by sellers, getting absorbed. Okay, that's not what absorption is. That is absorption at a specific point in time based on whatever, you know, interval you're talking about. You know, are you talking about that on a 1 minute footprint, on a 5 seconds? How many contracts? You talking about for the whole day? You talking about the A period? You talking about the B period? You know, when? Under what conditions? How fast is price moving? How many contracts are involved? How far, you know, if sellers are getting absorbed, what does that mean? You know, we're 1,000 to 1 buyers to sellers, or we're, you know, 1.5 to 1. Am I making my point, James? What's my point? And again, I'm not putting you on the spot. I'm actually trying to teach you. If you were a student, this is exactly what I'd be doing with you. Please, price action only. Okay, you're close. What I'm saying is, and what you've got, James, is you've got part of the puzzle. And again, with no disrespect, you're an example of Dunning-Kruger. you don't know enough to understand what the term absorption means. You've heard definitions, you've heard people talking about it, and so that's the whole point. To get good at reading order flow, you have to learn that terminology is irrelevant. It's about what's going on and interpreting what's going on within the context of the setup that you're trading. And that's going to be different for everybody. What's your absorption might be my perfect short scalp entry. Do you understand my point? It's a meaningless definition because A, it's different for everybody, and B, who cares? What's actually happening? Let's not define it. Let's just talk about what it is. So to answer your question about using supply and demand, of course I'm doing that, but I'm not using any silly definitions or any silly metrics. I'm looking at what's actually happening, and I'm looking at it within the context of the setup that I'm trading. And it's going to be very different the way that I'm interpreting order flow for a first hour high-low trade than I am interpreting it for a high Momo breakout, even though sometimes I might get those two events at the same time. Does that make sense? I'm trying to be as detailed as I can without being overly detailed, and also without being without talking down to you. What would you look for in the recording sessions on how to read the dome? Oh God, there's about 40 videos of that. I did a special workshop on that, which is 2 weeks long, and it's an add-on. If anybody wants this, you have to be a TRG member to get it, but it's $49. This is a really good example of something we do in TRG. I did a one-off called Boot Camp Chart to Dome, and I promoted it on Surfing the Markets, and it was a 2-week really intensive session on that very subject, and it was the only thing that we charged extra for in TRG. Let me go back to the website real quick. Hold on here. And in order to access that material, it's an extra $49 forever. And the purpose of that one thing, and the reason we made it separate, is that that is exactly what it's about. See right here, Boot Camp Chart to Dome. What I did was I did that specific topic for about 45 people. And so, you know, we charged a little bit, but I worked with one-on-one with everybody. And so that's what and so if you're interested in that, I would look at joining and adding that to it. And Lee can help you out if you want to do that. It's as I mentioned, our memberships is $99 a month. That's the only time we've ever done that. And so, you know, if you're interested in that, you can add it on. There's videos that talk about that throughout the library, but that was the only one that I specifically addressed that topic. For example, in the setup workshop, which you get as a member, the only thing that's extra is that one boot camp. I talked about it constantly over the course. You know, here's a live sample session. These are all domes and charts, and there's literally 30 videos here. I went through this over the course of 3 months for about 55 people. How to build a process, you know, that's included. The only thing that's not included is that one boot camp, that intensive session that we did. So I hope that that's a helpful answer to your question. And a couple of people are commenting in the Slack about that, how it was helpful. And everyone that was involved found it really helpful. I did as well. Okay, Joe says he's asking, I thought absorption was large passive traders holding the market at a level. That's another definition, Joe. Do you guys see the problem with all these silly definitions? Absorption is anything you want to define it. You know, depending on what Furu course you took on the internet, you'll have a different definition of it. You know, to me, absorption is when I spill a beer on my t-shirt and it soaks it up. That's absorption. It's a silly concept. You know, there's a million ways it could happen. So there's no one way that applies it or not. So the place to start would be, yes, for everybody that's joining TRG, the first thing we recommend that they do is go through and watch those videos for the workshop last fall, because it was literally a step-by-step that I did. That was the whole idea of it. And it was much more expensive than $99 a month. It was like $300 for 3 months. And I literally did that one step at a time. I started with the presentation just like this one. And then I walked it through, you know, how I learned this stuff and how I traded and how I came to the setups. And some of the setups in the workshop have changed because they've improved. Like the Open 5 used to be 1, and now it's the Open 5 A and B. It's 2 different setups. And I've learned a lot about teaching it. Same thing is true of range. I used to have one range set up. It's now 3 for 3 different sets of conditions. And by teaching it to the people in the workshop, I learned a lot about it. And then by practicing it and testing it, I found other ways to hone it down and make it more accurate. So that's why it's different in this presentation than it was a few months ago. Lee and I believe in constant progress and constant optimization. You never have a situation where everything is done, because that's just not realistic. Markets don't work that way. Trading isn't like that. You know, I just posted this in Top Step this morning. This is how trading education works. It does not work like the left. It works like the right. You have to constantly be improving your stuff and adapting and improvising, or you're just gonna, you might succeed, you know, you'll pass your combine and then you'll fail 2 months later. You know, it's a constant process. That's critical to understand. Okay. Questions, comments. That was a long hour and 50 minutes. I don't think I paused for a breath. So I need to do that. Anybody else have any questions, comments, anything else I can tell you about? Do I ever front run or only respond to volume? Again, James, your questions are phenomenal, but please listen to me carefully when I answer you, okay? By definition, there's nothing that I do that's front running. I'm only responding. You're stuck in this notion that setups have step 1, step 2, step 3, and that's furu bullshit. It doesn't work that way. And cool, okay? I just, you know, I'm trying not to be insulting and be respectful, but you know, that's such a common notion that front running the setups. Guess what? If you're front running the setup hasn't happened yet. It's that simple. I mean, you know, there's so much bullshit in this space, and I'm not talking to you, James. I'm talking to all the people selling you, you know, $5,000 indicators and Algo Box 5000 and E-mini Vinny and all the nonsense out there. You know, you will become an apprentice trader on your path to being a professional trader who makes money the day you abandon all that crap. Okay? And I'm kidding, but I'm not. I mean, I'm for emphasis, I'm laughing, but I'm dead serious about everything I just said. Any professional, experienced, profitable trader will tell you what I just said. Lee, would you put that in British, less American words, please?
Which part, Jeff?
The rubbish part.
Oh, this industry is full of people selling hope and dreams. And the louder they shout, and the more expensive it is, and the more opaque it is, the further you should run.
That's so true. God, how about those guys that, oh, I'm selling my proprietary oh, that's the guy I love now, black box algo. He's the new guy. Proprietary dark pools. And there's idiots giving this guy $99 a month for this quote unquote indicator. People, it's nonsense. Dark pool trades are for large institutional traders. They have nothing to do with futures trading or you. Complete nonsense, garbage, okay? You know, and if whoever owns that wants to come here and debate me real time with their indicator and my market tools, bring it. So whoever owns that, you know, whoever you know, if you know that person, throw that gauntlet down. Bring your black box algo bullshit nonsense, $1,000 a year crap, and I'll just trade order flow and we'll see how we do. You know, the more indicators you can get out of your chart, the only things on my chart are volume, price, and the delta. I have no indicators on any of my charts. So that's a key point. You know, indicators are useless. They really are. This is what my trading platform looks like if you're curious. Here, I'll blow this up a bit. I can, yeah. So I have a large 48-inch ultra high or 4K TV at the top, and I've just got some correlated instrument charts up there running very fast just to see immediate price action. My domes are in the middle, and that's what I trade off of. This one screen is my main screen. And then I've got 2 vertical monitors on either side, and that's where I watch footprints and I look for context like this 5-minute view over here, which is where I'm watching the first hour highs and lows, and I'm watching the market profiles, the volume profiles. and the wave volume. That's where I do that. All of my trading is done on the domes. I watch the tapes live. I'm looking at blocks because blocks are a piece of information that is an edge. You know, if you're at a price point and all the one lotters are buying and the big size are selling, you know, you see 50 go off on the sell side and one lot's going off on the buy side. That's a really good edge about which side of the trade you should be on if you're going to enter. So that's a good example of one of my edge tools right there. And notice how it's not about, you know, an indicator, or I'm reading the order flow. That's what I'm doing. Okay. Without further ado, I'm going to stop and pause and take a breath. Any other questions or comments or anything else I can do? Bar, it is a stupid question, but what does playbook EF great? Oh, okay. Are you asking? It's not a stupid question. Great. There's no such thing as a stupid question. You're saying, what does this symbol right here mean? Where is that what you're asking, Bar? Yes, okay. That's a poor use of a standard keyboard when I was doing this real fast from my bed in the middle of the night on a tablet computer. So that's the short answer. The long answer is what I'm trying to explain there is the price action. Remember, that's what those abbreviations are. The price action is going from ebb and flow to, that's a crude excuse for an arrow, to high momentum. That's what I mean by that. And this one means it's ebb and flow, or, you know, slash in math means or. This is high momentum or price discovery, ebb and flow or high momentum. And this one is very specific, and thank you for asking me about that. It's ebb and flow leading to high momentum. So what I'll have to do is find a better symbol for an arrow, and thank you for pointing that out. That's a good point. Okay, anybody else have any questions or comments? You know, those free people that are not coming back to join the group, I thank you for coming. I hope you learned something. You know, I purposely did a different format with 2 free sessions instead of, you know, the typical webinar sales pitch, you know, 1 free and then join our whatever, you know, because I really wanted you to understand how much meat there is underneath it here. And, you know, we're just such a different environment at TRG. So, you know, I really encourage you to give us a try and check us out. And I think, you know, you'll find it valuable. You know, no one has ever left. We have yet to have a member cancel and tell us that they did not find value in our group. The only reason that anyone has ever canceled, and it's about a dozen total in our existence, which is now 6 months or 5 months old, it was because people couldn't afford to do it, you know, for job reasons or whatever. That's the only reason anyone's ever canceled. So cool. Thank you very much. I hope, again, Meke, I hope I'm saying your name right. Everyone else, thank you, thank you, thank you. You know, if you can tell, if you can't tell, teaching is my passion. I love trading, but I love teaching. And if I can put the two together, it's like, you know, an orgasm. So, you know, I'm all here. Anyway, join us at TRG, or if not, join us for our next free event, which will be a month or 2 from now. And we'll look forward to seeing you at that. Last chance to ask a question. Otherwise, going once, burning desires going twice. Lee, have I missed anything?
No, you're good, Jeff. You caught everything.
Cool. All right, everyone, have a great, the next session, the first paid session is next Saturday, 5/9. The links will be posted in the group. What we do in TRG is we have a calendar page, and all of our live meetings are posted in the calendar. So you can see there that this session that we just finished is right there. So I'm going to delete that one. And then the next live session is session 3 and session 4. Plus we have a roundtable coming up on journaling at the end of May. And then there's actually 2 other sessions that I added, and I don't know why they're not showing up. Oh, here they are.
Jeff, it's probably worth explaining to James as well, between now and next Saturday, you know, we'll have 1, maybe 2 more sessions at least.
Yes. Oh, absolutely. I am going to add a live session. Exactly. Yes. So it's not just these 2. There'll be at least 1 live, probably the week once we get everyone on board. So the new people will come in, we'll do the 5/9 session, and then the week between 5/9 and 5/16, we'll do at least 1 live.
Oh yeah, but like, you know, aside from that, on Monday, we'll have our Ides of Monday weekly context kickoff. We'll have something on Wednesday or Thursday, no doubt.
Absolutely. Yeah, you know, I thought I posted Ides of Monday. Did I not do that? Oh, I posted office hours and open Q&A, which is tomorrow. So yeah, in fact, so yeah, I'm gonna do it right now. So while while you guys are posting whatever questions you have left, we have something, and I'll just tell you about it as I create it. We have a meeting every Monday morning that's called the Ides of Monday, and it's a little play on Caesar. And it's just a quick half-hour review where we kind of go through what we're going to do for the week. And, you know, we don't call trades, but we kind of organize ourselves and make sure everybody understands the challenges of the week. So I am about to put that on the calendar because I forgot to do it.
And Jeff, there are a couple of membership related questions which come into Otis, so I can see he's just signed up.
Can you answer them while I'm doing this?
Yeah, sure. So thanks for that. I was asking, you know, where should a newbie begin? Well, we recommend, you know, you go through the workshop from last year that Jeff did, which is a lot of content. Jonathan has commented in the chat about how, you know, that was his starting point. But what we're aiming to do actually over the next week is have Amy, who's one of our workshop graduates from last year, run a sort of interactive roundtable session together with David saying, here's my experience over the past year on this educational material. Here's where I started. Here's what I reviewed. Here's what worked for me. And then we'll be using that as a reference point for new people that join the group to say, you know, here's the direct experience that people have gone through and how it's worked for them. And in terms of Amy, who helps us out as a teaching assistant, cruise director, and ambassador for the group, you know, she'll sit down and scalp one tick for half an hour a day and consistently make $100 or so every day as a result of the process that she's followed in the group. So Otis, you know, we're looking to actually run an interactive session over the next week with real experience and guidance from people that have been through it and their recommendations.
And that's Amy right there with one of her horses.
Yeah. James has asked what time in the market would the live session be? Early morning? Yeah, typically pre-open or maybe about 30 minutes after the open. So I'm referring to regular trading hours or ES.
Yeah, if you look at the live sessions, there's recordings of a bunch of them, and I typically do them either right before the open, like Lee just said, or, you know, right afterward, about 9 o'clock my time. So about an hour and a half, 2 hours after the open. And if you just look for the word live, there's literally dozens of them here. Our ad hoc live meetings, just since February, we've done what, 24 of them. And those are really fun. We're reposting the one for Friday, by the way. Those of you that had trouble, is this the updated video or the old video, Lee?
It's updated. It was struggling at my end, actually, but I think that's my bandwidth while this was going on.
Okay, so I just want to see if it's clear now, because I want to show the people an example of a live video. Okay, yeah, here's one right here. So this is one of my live trading videos right here from Friday. And it's gonna, you know, you can see the market was running and I was showing what I was doing. I can't let it, the sound won't come across or anything. And we don't have the bandwidth to run this video out to all of you, but you know, if I just kind of stop it at a couple of different points, you can see I'm showing live examples of how my tools are being used and what my charts are showing at any given moment. So there's a ton of those in the library, and we did fix that one for those of you that had trouble with that one. All right, let's see. Go ahead.
John's asking about the boot camp videos. I'll drop you a DM very shortly, John, explaining how you can access the recordings and the private channel for the boot camp. And James is also asking, is one tick the typical scalp target? So why don't you talk to that, Jeff?
Yeah, no, it's not. We have a drill called a one-tick drill, James, and for the drill, it's the target to get a tick, because the purpose of the drill is not to make money, but it's to learn to read the price action. However, having said that, I do a variation of it where I trade for ticks, and this has been some confusion among our members recently too. And typically that's how I scalp. You know, my goal is always there's 3 outcomes that are acceptable in a trade, James. One of them is a small loss. The other is a break even, and then any win. Okay, but what's unacceptable is a large loss. So the rules of trading for a trader like myself that actually does this for a living and has done that, it's about protecting losses. It's not about targets. You take whatever the market gives you. So when I do my scalps, sometimes I take 1 target, sometimes I take 3, sometimes I don't do that at all because I know I can get more. And the live videos are a bunch of good examples of that. Do I have stops? Yes, but they're purely discretionary. I do not use mechanical stops. So it's no 6-tick target, 3-tick stops. That's more FURU bullshit nonsense. You can use that on a given setup, but there's no magic formula there, as all the gurus will tell you. You know, you have to have R to R of at least 1.8 to 1. Nonsense. All you have to do is make money more than you lose money. You know, there's so much crap floating around out there in this space. So you're being a good straight man and a good sport for me. It's really, you know, there are virtually, James, listen to this next thing I'm about to say. There are virtually none. There are virtually no non-discretionary professional traders. Let me play that again, okay? Most professional, the vast majority, overwhelming majority, over 90% of professional traders are discretionary traders. In other words, they trade based on market action. They don't use fixed targets and stops, and they enter the market when they see an edge to take money out of the market. That's what pros do. The crap you hear are sometimes good ways to learn to do that by understanding risk-reward management. But formulas of risk-reward management are nonsense, okay? So I hope that makes sense. It's a subtle but critical distinction. You know, when somebody tells you that they're a price action trader, there's discretion in there. You know, they may use a playbook based on indicators or based on market structure or conditions, but the execution of that trade is always discretionary. Okay, thank you. All right, any other questions, comments? I hope we accomplished some of our objectives, guys. I hope you learned a little bit about this ESP stuff, and I hope it was useful. And with that in mind, I'm going to wrap it up. So burning desires going once. You're very welcome. All of you are very welcome. And thank you. As I said, you know, this is my only reason for getting out of bed. And I got to just point this out to everybody. Talk about great process development. I love what you're doing here, Jonathan. Jonathan is working on his process right now as a newbie to our group. And this is his latest iteration. And as I said, I took this approach too with a flow chart. It's a really good way to learn the steps for yourself. So for those of you thinking that way, this is a really good example. And this is what we do in TRG. Jonathan, who's been commenting here, is sharing his stuff and asking for feedback, and we are giving it to him. And so, you know, that's what it's all about, and that's what we're all about. All right, please join us, and we hopefully will see you soon, whether you do or not. Good luck in the markets, and stay frosty out there. Thank you. Thank you, Lee, for your help.